Good afternoon and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Hello Michael, been a bit of a strange week this one.
It has, yeah. Very good afternoon to you, mate. Good afternoon to our listeners as well. It's been a holiday shortened week, but it certainly hasn't felt like it because there has been a hell of a lot going on. And of course, the tariff man is back in town and the trade story has reared its head yet again.
Yeah, only hours after we recorded last week's podcast.
With cracking
Donald Trump
timing
came
on
out
our
and said,
part.
right, 50% on the EU, I hate you so much. Or I'm paraphrasing slightly. But yeah, I mean, that sort of put a little bit of a dent in our podcast optimism. But subsequently, he's reversed ferreted on that. And actually, Wall Street have got a new nickname for him. I'll give you the honours of telling us what that is. But I found it highly amusing.
Well, thank you for that, mate, because that now means that if President Trump does listen to Good Money Guide podcast, I bear his wrath. But the acronym that everyone's come up with is TACO. Trump always chickens out. And, well, safe to say that the president is not particularly fond of that new moniker. But frankly, it is true because, as you said, on Friday we had the announcement of a 50% tariff on the EU from the 1st of June. By Sunday afternoon, the tariffs were delayed until the 9th of July. Whether you call it chickening out, whether you call it a reverse ferret, whether you call it a U-turn, certainly the can has been kicked once again.
Yes, and obviously since then the story's moved on further with a US court last night ruling that his Liberation Day reciprocal tariffs are an abuse of power and they block them. And obviously we'll talk a little bit about that in a minute, because obviously before that I have to do the risk warning.
Yes,
but I also have to highlight what we're going to be discussing today. Obviously we've had this week's Fed minutes, the numbers from B&Q owner Kingfisher, the numbers from Nvidia, which I think are a very interesting set of numbers, I have to say, before looking ahead to next week's ECB rate meeting and whether or not we'll see another rate cut. I don't think it'll make much difference one way or the other, and obviously the US payrolls report. So quite a lot to get through. But before we start the chat, risk warning time. So here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 74.8% of retail investor accounts lose money when trading spread bets and CFDs with this provider. I'll tell you something, mate. That first sentence, I think, they could do with being shorter or broken up into two. Just tell your compliance team that.
I shall. Or you could do some breathing exercises before the podcast, one or the other.
Anyway, so, I mean, basically, stock markets have continued to take the ongoing uncertainty in their stride. The DAX has made new record highs. We did see an initial pop in the wake of that news about the US court basically striking down the Liberation Day reciprocal tariffs. No one's really told the FTSE or the DAX, because ultimately we just sank back to pretty much where we opened. And ultimately, I think, and you can probably shed a little bit more light on this, isn't this merely a case of tariffs deferred rather than stopped completely?
Yeah, absolutely that. And I think you're absolutely right to say we did see that pop and then the move has paired. The same can be said for what we've seen on Wall Street in the S&P and in the NASDAQ, although both are still trading in the green on the day. I think fundamentally the ruling, and it sounds strange to say this, but it hasn't actually changed especially much. And the way that I framed it to you in our little chat earlier on is that it's effectively a different means to get to the same ends. What the court have done is they've said that under the IEEPA, which is an Emergency Powers Act, Trump doesn't have the authority to impose some of the tariffs that he has thus far. So the reciprocal tariffs that were announced on Liberation Day, the tariffs on Canada and Mexico, and also the tariffs related to the fentanyl that he's put in place on China. The thing is, and of course neither of us are legal scholars, but I feel like it given the number of opinions I've had to read this morning, there are other ways for Trump to implement tariffs on trading partners of the United States using various other sections of commerce and trade trade law in the US. And actually, a lot of those can bypass Congress as well. It just requires the Commerce Department to do some investigations and some reporting. So I think the reaction is completely understandable. When you're sat there and you see a headline that crosses and says court blocks Trump tariffs, naturally you go, well, wow, we should be buying risk. Stock should be a lot higher. A huge load of risk has come out of the market. But actually, when you start to dig into it a little bit more and the dust begins to settle, I think it's natural that participants have kind of gone, well, this is all well and good, but Trump's appealing it anyway. Even if the appeals aren't successful, then there are other ways in which tariffs can be put in place. Is the situation now, and this could be famous last words, I'm going to say it anyway, is the situation now that different to what it was 24 hours ago? Arguably not, I would say.
Or even a week ago when we were recording the previous week's podcast. I mean, ultimately, I think Trump is very fond of drawing attention to himself. And I think if he drops out of the limelight for even a day or two, he'll come up with some other outlandish announcement which will freak markets out. And obviously, we've talked about the big, beautiful bill. There are concerns, I think, within the bond market that could be, is fiscally irresponsible. But the US is hardly unique in running a big deficit when it comes to tax spending and tax receipts. Having said that, I think we are starting to see some signs in the bond market that people are asking, or investors are asking, for a much higher premium when it comes to long-term financing, long-term government debt. We've seen it in the Japanese bond market, we're seeing it in the US market, because when I'm looking at the 5 and 10 years, not really seeing that much movement relative to where we were in the start of the year when yields were higher.
No, you're absolutely right. And it is at the long end of the curve. As you say, obviously the 30-year trading up north of 5% for most of the week. I think I haven't got a screen in front of me, but we dipped just below it when I left the desk earlier on. Here in the UK, we've seen gilts continuing to soften. Obviously in Japan, that's where the big wobbles have been at the super long end of the JGB curve. And I think, it's a kind of classic example of the market always wanting to jump on the latest narrative. This time last week, we're talking about the fiscal side of things. Now we're talking about trade. But the deficit worries haven't gone away. They're still there. And this one big, beautiful bill is still on its way through the Senate and on its way to President Trump's desk. So I would imagine it's probably not going to be long until everyone jumps back into the short, the long end and steeper curve positions.
I was looking at the Fed minutes last night, and obviously...
Well, that sent you to sleep.
There wasn't really that much to see there, but I think one of the things I did take away from it was the fact that ultimately the Fed is in a very, very difficult position. They've got concerns about inflation quite justifiably because of the tariffs and when or whether they get implemented. Obviously, we've seen some evidence of the tariff effect in some of the earnings numbers that we've got out from the big retailers, Walmart. Today, we've seen Best Buy, which I think you could probably argue compares to Currys here in the UK, electronic goods retailer. They fiddled about with their annual guidance modestly on the assumption that tariffs will remain unchanged, which ultimately I think is a very big ask given the current uncertainty. But what else can they do? And I think one thing we could deduce, I think, given what we saw in Q1 with respect to the US economy, when the economy contracted, it's been revised slightly higher now, I believe, to minus 0.2%. We could see another contraction in Q2 because this delay to tariffs could prompt a number of companies to bring forward their inventory build from Q3.
Yeah, absolutely. I think you're absolutely right. And it's interesting. You mentioned Best Buy. I'm sure we'll discuss them a little bit later on. But the Fed minutes, you think about that last Fed meeting was held on, I'm going to get this wrong, I believe it was the 7th of May, 6th of May, 7th of May, something like that.
Earlier when I was off. So it was that week. It was the week after
down, mate, the number of holidays you have.
I can keep track, mate, believe it or not.
But anyway, the point is the Fed meeting was held earlier this month, and that meeting would have come before the US-China trade truce was agreed, before the trade deal, quote unquote, with the United Kingdom, before these threats of tariffs towards Apple, before these threats of increased tariffs to the EU. And that's just in the space of 2 or 3 weeks. So there's very little that monetary policymakers can do, as you say, other than just remain in this sort of wait and see mode, going until there's some clarity on the outlook. We just have to remain on the sidelines. And as you say, from a business perspective, all the while this uncertainty continues to linger, it's just going to continue posing a very, very stiff headwind to any longer longer term investments that they may be considering making. You're not going to, for example, build a huge distribution center in the United States to receive products from overseas if there's the potential for a tariff to be slapped on where you're importing your goods from before a shovel's even got in the ground.
You talked about obviously the trade deals or the trade deal with the UK. Does this court decision in the US change the dynamic around that? Does it perhaps make it a worse deal now?
Well, I mean,
will these tariffs come into play anyway? And obviously the EU has been talking about trying to arrive at a deal with Trump. Does that change its calculus when it comes to the speed? Because I think that was one of the reasons why Trump lost patience with the EU, because I think he felt they were negotiating in bad faith.
Yeah, I think you're absolutely right. I think that they're two very different things. I think with the UK deal, well, it would actually be nice to see it written down, because I don't think there's still a sort of formal written agreement as to what they've signed up to. But that does seem to be sort of done and dusted. I think the EU deal, and actually trade deals with all other countries, the direction of travel is still towards a sort of calmer tone in terms of rhetoric, towards deals being made. Although, as you rightly allude to, I think the European Union and their 20-odd member states have a very different definition of the word fast than President Trump does. And I think, frankly, whether it be on the issue of tariffs, whether it be on something geopolitical or something else entirely, that's probably going to be a sticking point between the two nations for most of the next 3.5 years. But I struggle to think that anyone will see this court ruling and say, okay, let's drag our feet. Okay, let's play for time. Let's see if we can just wait this out. I think given the ease with which Trump flies off the handle and throws tariffs around, I think it would be sort of folly to play that strategy, really.
Yeah, and giving his touchiness about the TACO acronym, I would suggest that it's probably going to make him even more unpredictable and short-tempered, given his response to that reporter's question.
Yes, very much so.
Press conference. He's very thin-skinned and probably won't take much for him to start shooting from the hip again.
No, especially
or shooting from the lip, shall we say.
Very good, especially when in the last 12 hours we've had a journalist asking him apparently the nastiest question he's ever been asked, and now the court saying he can't do what he wanted to do in the way he wanted to do it. I would not want to be the poor butler in the White House who has to wake him up this morning. Let's put it that way.
No, indeed. So I think the key takeaway for this is nothing has changed. This is just background noise to the inevitable implementation of tariffs whenever they may be. And ultimately anything else around that, it's really just a question of preparing for that day.
Absolutely. Of course, we are in worryingly rapid fashion getting close to the expiration of that pause on Liberation Day tariffs. The 8th of July is 5 and a bit weeks away. It's going to come round very, very quickly.
Yeah, I can't believe it's June next week.
I know. The year is literally flown by.
Where's the year gone? It only seems like yesterday. We were talking about, what's 2025 going to bring us?
Yeah.
Anyway,
I don't think we'd have predicted any of this.
I mean, we knew Trump was going to be unpredictable. We just didn't know how.
Yes.
And he certainly, I think, caught pretty much everyone off guard. Perhaps maybe we shouldn't have been surprised, but I think an awful lot of people, me included, were looking at what he did in his first term and thinking, well, how different is it likely to be? Well, quite a bit different, because obviously he's got a much bigger mandate now.
Indeed.
There's a very decent article by my colleague Jackson Wong on a Good Money Guide called Tariff Tantrums, Bond Concerns and Emerging Market Opportunities. It was written in response to obviously the 50% tariff announcement. So it might be a little bit dated, but I think the underlying theme is nonetheless still pretty valid, and particularly when it comes to the bond markets, because there are still concerns about inflation and deficit rules. What do you pick? US yields, US bonds, US treasuries, JGBs, Japanese government bonds, German bunds. Probably as a percentage of GDP, their debt pile is the lowest, but that doesn't include most of the stuff they've bunged off balance sheet, which doesn't count. So, and then of course, UK gilts. Again, here, there's concerns about government spending here. So for me, I don't think there's really any safe haven per se. It's just some havens that's probably safer than others.
Yeah, exactly. And I think fundamentally, and I think we probably mentioned this before, it's a case of everyone is really facing the same issues. Would you rather hold gilts over treasuries? No, absolutely not. No matter what Trump is doing or saying, Treasury, and for that matter, no matter what the ratings agencies are saying as well, treasuries are still the safest of safe debt out there, to be completely honest with you.
Well, I think it boils down to this, Michael. If US Treasuries are a dodgy bet, then we're all in big trouble.
Yeah, absolutely. You're absolutely right. If the US gets into some trouble, then everyone else is probably going to be in worse trouble. Let's be honest.
Yeah. Okay, so let's move on to this week. Obviously, we've had a look. We've sort of looked at the broad overview. We've had a broad brush strokes overview of what markets are having to contend with, and ultimately, it's not really been that different for the last 2 or 3 months. Stock markets, UK FTSE 100, it's still just below the record highs of earlier this year. The DAX is making new record highs virtually on a weekly basis at the moment, but very incremental in basis. S&P 500, it's modestly higher. It's still below 6,000. Though it's struggling to get through that level and below the record highs that we saw in February. The Nasdaq's had a fairly decent rebound today, but again, it's paired an awful lot of those gains and still below the record highs in February. So ultimately, while we've recovered an awful lot of the losses, I don't think the investment picture is any clearer than it was, say, a month ago.
No, I mean, clearly the price is very different, but I would agree the economic outlook remains just as uncertain and just as volatile, and so does the market outlook. But the one thing I would come back to, as I said a moment ago, is I still think we have moved past that point of sort of chaos and peak uncertainty that we saw at the start of April, the first couple of weeks of April. Even though there is still the threat of another Truth Social post being just around the corner where tariffs are increased or a new sector is targeted, I think the broad dynamic remains towards agreements being struck. And amid that backdrop, we've got economic data that remains resilient and an earnings season which is just about wrapping up and actually hasn't been that bad. So, still relatively constructive when you look at the equity space, in my view.
Yeah, and we got some evidence of that this week with the latest first quarter update from B&Q owner Kingfisher. Unsurprisingly, we saw a fairly decent performance from the UK operation. Now, why do I say unsurprisingly? Because we had a fairly strong UK economy in the first quarter of this year. The UK operation of Kingfisher saw sales increase by 6.1% to 1.7 billion. Like-for-like sales rose 5.9%, pushing total sales up to 3.3 billion pounds. Why was that, I hear you ask? Well, warm weather. The early spring prompted an awful lot of people. And we saw that manifested in the retail sales numbers. So I would have been surprised, given the retail sales numbers, if B&Q Kingfisher hadn't recorded a strong performance in its first quarter. So I think, as we listen to all the siren calls of doom and gloom, recession, and we're as guilty of that as anybody else, I have to admit.
Yeah.
At the moment, looking back, the UK economy looks to be in a fairly decent shape. But as we both said, it's not about the rearview mirror, is it?
No, it's not. And I think that's exactly the way to frame it. In the first 3 months of the year, the UK economy was in very good shape. And I will happily admit, surprisingly good shape. I was a lot more downbeat on the UK economy coming into this year and through most of the year so far than the data has borne out would have been valid. And it's no surprise to see someone like Kingfisher delivering a strong earnings result when, as you say, we have had those other indicators pointing towards that coming on its way. That the question for Kingfisher, for the UK economy at large, is can we keep up that level of economic performance with the downside risks that are mounting, be that trade tensions, be that national insurance having increased, be that the increasingly high likelihood of even more tax hikes coming in the budget in the autumn. I think they're really the questions we need to be asking. We can sort of sit here and say, okay, great, let's pat ourselves on the back. We have surprised to the upside of expectations thus far. Can it continue? I would be dubious at this point.
Yeah, I mean, I must admit, I think if you can compare and contrast Kingfisher to the performance of its French business, that continues to be a dog's breakfast, basically. Underperformance sales declined 4.9% to 976 million, 3.2% on a like-for-like basis. There is still no indication there that business is being turned around. They performed in line with expectations despite challenging market conditions. Well, did they have different weather to us here in the UK? I don't think so. So it sort of.
I must admit, when I was preparing for this podcast, I saw that I did think to myself, I know that France is not the UK and the UK is not France, but how different can they be, really?
Not that much different. They still have the same problems that the UK economy's got.
Mm.
Bloated public sector, huge deficit.
Yeah.
Their roads may be better, and the weather may be slightly warmer, and the food might be better. But ultimately, everyone has to do the same thing. And for me, they're chalk and cheese. And I've said it before, and I'll say it again. What the hell are they doing with that French business? Just get shot of it.
Well, the question there is who'd buy it, but I think
Well,
that's probably a topic for another time.
Spin it off, IPO it in the French stock market.
Just do something to get rid of it.
Yeah,
because it is clearly a drag on the rest of the firm.
I mean, one of the things about the UK is that both Screwfix and B&Q had a strong quarter. In fact, B&Q had a stronger quarter than Screwfix, and that is the exception rather than the rule when it comes to recent earnings announcements out of Kingfisher. But someone forgot to tell the share price that it was a decent update because it's trading at 2-month lows,
which is peculiar, I must admit.
Yeah, it is.
Particularly when, as we were just saying earlier on, the broader market is actually trading in relatively positive fashion this week. Yeah. And to be completely honest with you, it's a decline that I'm going to struggle to explain, unless it is a case of focusing on the continued dismal performance of the European business. The outlook was maintained rather than upgraded, but I feel like I'm clutching at straws a little bit.
A little bit. It has seen a decent rebound since the lows back in March. So I think there's an element of that. It's giving back half of that, and perhaps there was, I think, some disappointment that because they had such a strong first quarter that they didn't tweak their guidance higher a little bit. But when you look at the state of the French business and the Polish business as well was disappointing as well, you're sort of thinking, well, maybe this is as good as it gets for the UK.
Yeah, potentially, certainly given those risks that we just mentioned, and also if a degree of the performance is down to the weather, well, actually some of that is likely to be people pulling forward some purchases that they may have made later in the year. So where they've had a very strong Q1, are we looking at perhaps a slightly weaker summer period as a result of those purchases having already been made? Only time will tell, but that may be another reason guidance was steady.
I think that's an element of that, most definitely. Anyway, as I say, there wasn't an awful lot to talk about on the earnings front, I think, here in the UK, unless I've missed something. So let's move on to Nvidia last night, because just looking at my Nvidia chart right now, all those early gains that we saw post results, they've gone. I think Nvidia shares are now flat on the day. So, yeah, I think there's a little bit of tempered expectations with regard to that, but it's still above $140. And when we were talking a few months ago or a few weeks ago, I was concerned that it was going to drop below 100, and it did very, very briefly before rallying back from $90. So it's had a fairly decent rebound from the lows. The numbers, do you want me to do them?
Well, yes, please do them. But first of all, can I just have a bit of a rant, because whoever at Nvidia is in charge of releasing those numbers made an absolutely horrific typo with those very numbers last night, getting their margins out by 10% and getting their EPS out by 15 cents before sending out a correction 15 minutes later. So the reaction in the share price has been an interesting one, because I sort of sat there at the desk last night going, well, these numbers don't look very good. Why are Nvidia up by 4%? And then all of a sudden you get the correct numbers, which you're about to give us, and the reaction makes a hell of a lot more sense.
Okay, well, I took these straight off the Nvidia website, so you'll have to tell me whether or not
we can have a little starter for 10, can't we?
Got the correct numbers. So Q2 revenues, $44.1 billion, which was a 70% increase on the previous year and above its guidance target of $43 billion, plus or minus 2%.
Yep.
They took a write-down of $4.5 billion on their H20 inventory because of US restrictions on chip sales to China, which meant that it couldn't ship an additional $2.5 billion in sales during Q1. Gross margins would have been 70.13% during Q1, excluding this charge. Including this charge, they fell to 60.5%. Now, is that right?
The number I've got is 71.3%.
Yeah, but that's excluding the $4.5 billion write-down.
Yeah, that's the adjusted figure.
If you include that, they're 60.5.
Yeah.
There's two separate sections.
Yeah.
On the earnings announcement. So, unless they've got it wrong on their investor relations site.
No. The figure I'm looking at is the adjusted one, because that's the figure that they'd issued guidance for previously, between 70.5 and 71.5.
So, including the charge, they fell to 60.5. So that's a one-off, essentially.
Yeah.
Data center revenue continues to be the main driver. That rose 10% from the previous quarter, up 73% year on year. $39.1 billion of that, $44.1 billion. Q2 guidance, $45 billion, plus or minus 2%.
Yep.
So again, fairly decent, but tempered by the fact that each 20 revenue will obviously be lower as a consequence of that.
Yes.
But even so, that's still a fairly decent increase on Q1.
Yeah, absolutely. And I think, setting aside the jiggery-pokery going on with the numbers, there's really not a lot to complain about in that report, to be completely honest with you. Margins are still pretty healthy. Well, certainly when you look at the adjusted figure, the guidance is pretty solid. They are. It's staggering to say it, given that we're sort of 2.5 years on from when this mania over Nvidia started. But expectations keep getting higher and higher, and the firm keep meeting them and keep setting the bar higher and higher. And it's staggering to see them do it. But realistically, there is not a lot. Actually, there's not anything to dislike about the earnings. I guess the most interesting point from me was to see the CEO, and this is no particular surprise, talking in various media interviews afterwards, trying to get the Trump administration to modify and soften some of their chip rules, which obviously would be a boost to the firm. Can't imagine Trump's going to listen to him too much. But yeah, I mean, we all went in with anticipation going, can Nvidia meet expectations? Can they do it again? Definitively, yes, they can.
Yeah, it was interesting that the guidance for Q2, which is 45 billion, the guidance reflected an estimated $8 billion loss in H20 revenue due to the newest restrictions. So, I mean, that's 53 billion if you include that.
Yeah.
Which is a sizable increase. And something that was actually quite interesting to note on the outlook or what's coming up. And it makes sense that they're doing this given Trump's visits to Saudi Arabia and Dubai.
Yes.
Is that they're taking steps to diversify their customer base, setting up AI hubs in Saudi Arabia and the United Arab Emirates with fancy names like Humane and Stargate UAE.
Yeah, I dread to think how much consultants have been paid to come up with those names. But in all seriousness, it is a very positive step. Clearly, you can justify the political side of it somewhere else. Clearly, the Trump administration want to sell chips into the Middle East. And I think it makes a hell of a lot of sense for Nvidia to sit there and assess the environment to go, actually, China's been a huge market for us. The landscape has shifted, thus that we need to diversify our base. And I think the other thing to consider is, we do have the 8 billion loss in the guidance. If there are some tweaks to the chip regulations, if the tone between the US and China does somewhat soften, does that potentially open up the scope for an even better Q2 than they've been leading us towards? That's the upside case. Nor would I. But it's worth considering at the very least.
Given the national security concerns that they've cited, I would imagine that's probably not some. I think the diversification route. I think the diversification route is the one that's probably going to be the main story. But we'll see. Looking at Best Buy again, they're down 7%. So not a particularly great reaction to a mixed set of results. Revenues were light, but profits were better than expected. So,
yeah, and like we said earlier, I think the market's probably taking quite a dim view of the guidance, as you say.
Seems a bit of an overreaction, though.
It does feel like a bit of an overreaction, particularly, certainly one, when you consider the broader market is trading higher, although we have paired some of the gains. And secondly, when you consider, as you said, they've assumed that tariffs are going to remain unchanged, which is a perfectly reasonable accounting assumption to make. But from a sort of rational financial markets macro perspective, you would say the correct assumption is probably that tariffs will actually end up lower than where they are now, or at least when they put that forecast together. So, yeah, I wouldn't be surprised if we did see a bit of a rebound there.
Okay, so that's this week. Not really much else to sort of really talk about, unless I've overlooked something. Is there anything that you want to?
Well, the only thing I would mention, and we're going to come on to this in a second, so it'd be a nice little segue into that, is the jobless claims figures that we had out of the US about 90 minutes or so ago. And the only reason I mention it is, or one of the reasons I mention it, is because the continuing claims number at 1.92 million, not only is that above the forecast range, it's also a new cycle high in the week that coincides with the May non-farm payroll survey week. So we've been saying for some time now, is the US labour market going to soften? Are we going to see the pace of job losses pick up? Well, we're not necessarily seeing the pace of job losses pick up just yet, but certainly what that data is telling us is that when people are losing their jobs, it's now taking them longer and longer and longer to get back into employment, which I think is an interesting sign and perhaps a sign of that trade uncertainty beginning to negatively impact companies' hiring plans.
Yeah, I'm looking at the continuing claims on a graph, on a pie, on a graph.
It's not a spike, it's just sort of slowly moving higher.
From the 1st of May, 1.91 million. So
yeah,
it's matching the cycle high of earlier this month. So yeah, I take your point, but we're talking a very, very small number here. I think if it goes above 1.95, then maybe we might have reason to worry. But certainly, I think looking at the average, we've been around about 1.9 million for about 5 or 6 weeks now.
Yeah, so, let's see. I'm a little bit more concerned about that than you, I think, but okay. I'm certainly not going to sit here and sound the alarm just yet, but something to keep on the radar.
Okay, payrolls.
Indeed.
Okay, so we're expecting a number of around about 130,000, I think.
Well, you're going to be more informed on that than I am, because when I looked on Bloomberg earlier, there was no survey numbers. I think we're a little bit early. I know we came in at about 177,000 last time out, but I'm not sure where we're landing this time just yet.
Yeah, I think Reuters have got a survey of 130, which coincidentally was the same as the survey number for last month, but which saw the numbers come in at 177, I believe.
Yes.
So I'm guessing they're looking for a similar sort of number to the one they estimated previously, which again, doesn't raise any red flags, does it?
No, absolutely not. I mean, I think the way to look at the US labour market is the way that you should gauge non-farm payrolls growth from an economist perspective is not against expectations, it's against what we would call the break-even payrolls pace, which is basically the number of jobs the economy needs to add every month to ensure that employment is keeping up with growth in the size of the labour force. And that rate is at about somewhere between 80 and 100,000. So anywhere north of that, yes, it's going to cause some intraday fluctuations in financial markets, but anywhere north of about 80,000, you would say the labour market is still ticking along just fine.
And vacancy rates are still relatively high. I think they're still above pre-pandemic levels, whether or not they're real jobs or not.
Yeah, and it's a weird one because, you look at the sort of holistic view of the US labour market, you've got a decent clip of non-farm payrolls growth every month. You've got relatively low unemployment. I mean, we typically say anything below 5% is full employment. We're well below 5%. We're much nearer 4%. And earnings growth is maybe a little bit hot, but it's cooling, and it's broadly compatible with a return to the 2% inflation targets. If you ignore tariffs and just pretend that tariffs don't exist, you would actually say that this is Goldilocks US labour market. The problem is that we've got this sort of sword of Damocles hanging over things with the uncertainty that Trump's trade policies are causing, whereby of course the Department for Government Efficiency and all the federal job cuts, where every month we're going into the jobs report going, is this going to be the month where we get a negative number, or a huge negative number, and everyone starts to panic on the back of it? Because if that wasn't happening, you'd actually be sat here going, the labour market is in pretty damn good health.
I think there's also an overarching narrative of us as market professionals. We basically get exposed to all the headline risk, all the red tops screaming negative headlines. Ordinary person in the street really doesn't give a monkeys about any of that and just carries on regardless. And all they care about ultimately is whether or not they've got enough money every month to be able to pay all their bills for the month until their next paycheck. They don't really pay that much attention to the scribblings of you and me or anyone else for that matter.
Let's hope they do pay attention to this podcast.
Well, of course, but my broader point is that sometimes people like ourselves, we can get too close to it and we can't see the woods for the trees.
No, you are absolutely right, and I think the jobs, the non-farm payrolls number is actually a classic example of that. We're sort of sat there you're probably in the pub nowadays, but I'm sat there at the desk on the first Friday afternoon of every month, on tenterhooks. Is it going to be 130? Is it going to be 140? Is it going to be anywhere near my guess? We're massively reacting to a few thousand jobs here or there, whereas fundamentally the trend is actually that things are pretty stable, and most people in the United States have a job, have a stable income, and are doing okay.
Yeah, despite declining consumer confidence numbers and all these survey reports that I read, I've never been asked once about my views on the state of the UK economy, whether I'm better off, worse off, or whatever. So I don't know where these panel surveys get their responses from, but ultimately I've never met anyone who's actually participated in one.
So nor have I.
So that suggests to me that they can be very arbitrary, and ultimately they're only a reflection of headline risk as opposed to actual day-to-day spending.
Yeah, and I think that's probably one of the reasons why, not just in the US, but actually here in the UK as well, we have seen this big fall in sentiment, but we haven't seen that translate into a decline in spending, whether you look at retail sales or whether you look at corporate earnings. And I think that disconnect between the two probably owes to the nature in which the surveys take place. That it sounds ridiculous, but there is a big difference in asking someone, how do you feel about the state of the economy, and then comparing that to how they are actually acting within that economy. They are often two very, very different things, and so it is now proving once again.
Well, it also depends on how you phrase the question.
Yeah, of course.
How do you feel about the state of the economy? Okay.
Yeah.
Are you optimistic or pessimistic about the UK economy? Okay, pessimistic.
Yeah.
Slightly different nuance in the response, but ultimately I think it can, shift people's biases, if you like.
Yeah.
And when you look at the clown show that we've got as a government, perhaps it's not surprising that consumer confidence still remains fairly weak. And they're talking about implementing future tax rises in October, which ultimately will probably make the economy even worse.
Yeah, and I think it's interesting that we're sat here at the end of May and the pre-budget trial balloons have already started to be flown. You look at the chatter around ISA, cash ISA limits that's been going on for some time. There were reports earlier this week, I believe, around getting rid of salary sacrifice, which I know a lot of people are using, myself included, in terms of their pension contribution and things like that. And so already we're starting to see the direction of travel become, well, it was pretty clear anyway, even clearer towards the fact that we are all going to be paying a hell of a lot more tax come the autumn, and that will naturally have an impact on confidence.
And then you've got these trial balloons about ministers to get the power to force pension funds to invest in the UK. I can't think of a more stupid policy.
And let me clarify, and I'm probably speaking for you here as well. I would love to see more people invest in the UK, whether it be public markets, private markets, whatever. We want the UK to do well. We want the UK market to do well. We want the UK economy to do well. The way to achieve that is not to force people to do it. The way to do that is to generate an attractive investment environment, generate a favourable corporate environment, generate a well-performing market, and the capital will come naturally. Writing a sort of government edict to force people into bringing cash into UK, and when they do it, forcing them to invest it in a certain sector is absolutely the wrong way to go about doing it.
Yeah, I don't think it'll affect pension plans of, say, you and me, because we already have our own private pensions, which are supplemented by our employers or money that we get organically. I think if you're a public sector worker, I think you should be very concerned about that, because ultimately it could diminish your returns quite substantially.
And I think actually that is a very, very good point that you made just at the end there. And again, no lawyer. We've spoken about a lot of legal things during this podcast, but I would imagine that the government are going to have great difficulty in actually forcing this legislation through, because there is, I would say, a very strong argument that forcing or mandating investment in certain markets or asset classes goes against the duty that pension trustees have to their pensioners and to their fund holders, forcing them to invest in something that could offer subpar returns. I think it's going to be quite easy to argue that that is not in the best interest of those with money in the fund.
Well, I certainly think shareholders, particularly in the publicly listed companies, will have something to say about that. I was reading somewhere that as a result of ESG, which obviously has, I think, seen its day, Legal in General being a case in point, and they're calling out BP management for their reversing or pulling back from their renewables legislation. Well, I would actually humbly ask them, if I was a shareholder in Legal in General, on what premise do they put ESG and environmental guidelines over and above their fiduciary care to shareholders and pension holders. Their duty should be the latter, not the former.
Yeah, absolutely. I completely agree.
Okay, as long as it's not unethical.
Oh yeah, of course. There is a line to be drawn, but fundamentally, the priority number one should be ensuring a solid return for those shareholders.
Fiduciary duty.
Exactly.
That's it.
It's interesting that is actually, and I know he's gone back to the firm now and left the government. That's the case a lot of pension funds in the US were using against Elon Musk's involvement with Doge, saying that you've got a fiduciary duty to Tesla shareholders that you're at risk of neglecting because you're running around Washington, D.C. trying to run the government. So there is a sort of precedent there, and it's a long-running precedent.
Okay. ECB, European Central Bank. I don't mean the English Cricket Board, even though I have been watching the cricket. What do you make of it? A rate cut next week?
Well, I think the ECB is actually relatively straightforward at the moment. They're going to deliver a 25 basis point cut next Thursday. They're probably going to come out and again say that they are in a data-dependent mindset. They'll take things meeting by meeting. We're not on a preset course. Well, to be honest, I think the course is pretty preset at the moment because you've delivered 8 cuts in a row, I believe it is. So.
Well, this would be the 8th if they do it.
Yes, you're absolutely right. So 7 cuts in a row, the 8th is on its way. Yeah, you can say you're not a preset course, but that's autopilot to me. And I think certainly moving to the July meeting, the risks of inflation undershooting the 2% target are growing. The downside risks to the economy from a growth perspective are growing. They'll probably continue with another 25 basis point cut in July as well, I would imagine. I think as central bank meetings go, it could be a bit of a boring one.
Yeah, yet despite 7 rate cuts, soon to be 8, euro-dollar is higher now than it was this time last year.
It is, yes.
So it's going well.
It's going about as well as anything else the ECB have ever done, so we shouldn't have high hopes, really, should we? But no, you're absolutely right. I mean, if you ask ECB policymakers, that's because the euro has an increasingly global role and it can be a safe haven, which is complete nonsense. The reason euro-dollar's trading at 115-ish is because everyone wants to get out of the greenback, not because the eurozone economy is suddenly going gangbusters.
Yeah, I'd caveat that slightly. It's not a case of everyone wants to get out of the greenback. They're just reallocating their capital allocations to be lighter the greenback.
Yes.
I wouldn't say getting out of the greenback because the dollar is only a little bit weaker than it was, say, perhaps, 2 or 3 weeks ago. So it's not really going anywhere. Yeah, there is downward pressure on it, and that downward pressure is likely to continue. But ultimately, on interest rate differentials, the dollar should be higher.
It should, but I think
it's not.
For some time now, the market has been, well, frankly, ignoring rate differentials. The focus has been elsewhere, namely on the issue of trade, as we've sort of done to death over the last 3 months or so.
Do you think it will be a unanimous decision to cut rates if they do cut rates next week? Because I'm not sure it will.
I don't think it will, and of course the caveat to that is that the ECB don't publish a formal voting record. We have to rely on sources' stories and whatever Madame Lagarde has to say.
Do they update their guidance for this year as well? It's an economic review, isn't there, next week?
Yeah, so firstly, I don't think it will be unanimous because Austrian Governor Robert Holtzmann, who is a sort of uber hawk, has already said he doesn't think they need to cut in June or July. So he's probably almost certain to dissent against that. But yes, they do update their economic forecasts this time around. And going back to your point on the currency, last time the ECB produced their forecast, which was back in mid-March, not only did we not have any tariffs at all, but they also assumed for the next 3 years over the entire horizon that euro-dollar was going to trade at 104. But we're now trading at 114. So that in itself is going to have quite a big impact, lower in terms of growth and lower in terms of inflation before you consider any of the trade stuff.
That's a huge myth, isn't it?
Massive.
I mean, that's a forecasting black hole, that is.
Yeah, and actually, just to, I'm just going to get the precise number on my screen in front of me, but just, in case anyone thinks, oh, that's only a dollar issue. If you look at the ECB also put in their trade-weighted euro index, which is basically the euro against a whole basket of other currencies. Well, they thought that was going to be at 122 for the next 3 years. Well, it's actually at 129 and a quarter now. So they've got it horrifically wrong on both of those, which is going to have a big impact on the forecasts.
Yeah, I was looking at the latest lending survey, ECB Bank lending survey data, and it showed that demand for credit was slowing. which suggests that the problem isn't the level of rates, given the fact that we've seen 7 rate cuts already. It's more structural than that.
Yeah.
And that, for me, I think means that, and I've said this before, it doesn't matter how low you cut rates. The problems in the EU are not to do with the level of borrowing, it's due to the structural with respect to the euro. And while it's perfectly reasonable to look at Germany and think that there's going to be an awful lot more spending now that they've relaxed the debt brake, the reality is I don't think it's going to be anywhere near as quick as perhaps they would like it to be.
No, I would agree, and I think it's been the case for a hell of a long time now that the ECB are frankly pushing on a string when it comes to monetary policy. I would contest that we currently have the deposit rate, or it's going to be lowered to 2% next Thursday. I would say that you could put that at 1, you could probably put it at 0. And the impact on the Eurozone economy is going to be marginal at best. It is structural issues that are holding Europe back, and it's structural issues that have been holding Europe back for the last decade or so, if not longer. The ECB are doing their job. I can't believe I'm feeling sorry for them. They're doing their job to the best of their ability because the only tool they have is to lower rates and buy as many bonds as they can. They need some help from the governments within the bloc.
Yeah, it's been well documented. Mario Draghi did a paper on it. He's the latest in a long line of ex-policymakers who've done a paper on it. And at the end of the day, nothing ever really changes. Okay, we've done that topic to death. I don't think we really need to talk about it anymore.
I agree.
We've got flash CPI out of the EU next week for May. That's likely to drop to 2%. So they're back on target. Core CPI, 2.7. Whoop. Now we've got UK lending data and mortgage approvals data for May. Now, that was a bit of a surprise, the April data. We talked about it a little bit 2 or 3 weeks ago. It absolutely surged net lending to individuals to 12.96 billion from 3.8 billion in March. So much for the change in stamp duty rules prompting a slowdown. If anything, it sped up. What was interesting was a very sharp slowdown in consumer credit in April, from 1.35 billion in March to 175 million in April. What's that lending data and mortgage approvals data going to tell us for May?
Well, it's all been a bit, as you rightly alluded to, it's been a bit weird, to be completely honest. The fact that we saw this big surge in borrowing in April when the stamp duty cut expired at the end of March is a massive head scratcher. I would imagine that given the scale of the rise that we saw in April, some of that is going to be given back this time around. But I think this comes back to the sort of fundamental disconnects that we see in the UK and everywhere else, again, that we've discussed at quite some length before. The Bank of England have delivered 100 basis points worth of rate cuts. Whether you look at swaps, whether you look at gilt yields, they're all higher this year. So the transmission of those rate cuts through to the real economy, the end of the pipeline, where people are getting mortgages, where people are taking out credit card debt, whatever it may be, that transmission is not as strong, it's not as forceful as, well, certainly we or the Bank of England would want to see. And, you've got to question whether that eventually begins to pose a more significant headwind to some of these borrowing numbers.
Well, they're due out on the 2nd of June, so it'll be interesting to see what dynamics are at play there and whether or not we'll see a slight realignment after the rather strange numbers we saw in April. Moving on, E&M European Value Retail full-year numbers. They're just going to reiterate what they posted pre-close results back in April, so I'm not really expecting too many surprises there. Seen a fairly decent rebound in the share price in the last couple of months, and we've traded sideways pretty much for the last 3 weeks, around about 3p. I still think they're underpriced, but the problem is at the moment they look a little bit overbought. We've seen a decent rebound. Are they going to surprise? It'll be interesting to see what their guidance is. They are opening new stores, another 45 expected in 2025. They also operate in France like Kingfisher, but their French operations look slightly healthier. So they're an interesting one, budget retailer.
Yeah, and you would expect, and again, we've mentioned this previously, you would expect that if we are seeing a situation where the economy is starting to roll over, these sort of the more budget retailers you would expect would perform relatively well. But I think the potential for surprise from these figures is relatively low, given that they've sort of almost effectively told us what they're going to be already. And actually, to be honest, the stock hasn't really gone anywhere for the last month or so since they announced the pre-close results.
Yeah, and these are due out on the 4th of June. We've got Chemring's first half numbers. They're a UK defence contractor. We did a piece, Michael and I did a piece on that earlier this year. They've seen a really good surge in their share price, part of which was down to a bid approach from Bain At the bid that was 390p. At the billion pence, they're now at 480p. So their first half numbers on the 3rd. I've written about that on my Substack, so if you want to read in slightly more detail about that, feel free. But certainly I think the defence sector is one area of the UK market that could continue, touch wood, to do reasonably well.
Yes, I would agree, and actually I would say that that's not just the case for the UK. I think that's probably defence stocks globally. Given the ramping up that we're going to see in defence spending from pretty much everyone, I think that is one sector that there's obviously never a sure thing in financial markets, but the bull case is a very, very strong one indeed.
Yeah, I mean, since we talked about Chemring, it's gone from around about 360, 370, it's now 480. I mean, its record highs are around about 2012, I think it was around about 600p. So it's still well below those levels. And it's been as low as, I think, 2020, in fact, 2022, it was down around about 250p. So it's certainly been an interesting ride for shareholders over the last 15 years.
Yes, absolutely.
British American Tobacco, big UK corporate, flies under the radar. The end of 2023, shares slipped to a 13-year low. They've recovered quite a bit since then. Fairly decent dividend payer. Took a big impairment at the end of 2023, but their shares are they're doing okay. Traded between 3,035, 3,000 and 3,400 pretty much for most of this year. So it's one of those dividend stocks that it's a bit boring, but is also very expensive.
Yes, and as you say, it's just sort of plodding along, and it has done for most of the last sort of 5-6 months this year.
And when I say expensive, I mean per share.
Yes, yeah.
35 quid for one share. It's a lot of.
It's pretty
30 quid for one share. It's a lot.
Yeah, there's currently people who trade a lot of US equities laughing at us, thinking that's a lot, but in the London market, it is a lot.
It's a lot.
None of this $140 a share nonsense with Nvidia.
Not when you're paying 78p for Lloyd's Bank shares.
Yeah, exactly.
Other GameStop first quarter numbers on the 6th of June. That's an interesting one, given what happened earlier this week with their purchase of Bitcoin. I mean, I look at GameStop and I think you've been doing okay. You've returned to profit. You put your FTX scandal behind you, your crypto exchange scandal behind you. You put your non-fungible NFTs behind you. And now what are you going to do? You're a game store retailer. Stop messing about with crypto. It's burnt you before. Who's to say it won't burn you again?
You just want to sit there and go, be a proper company again.
Yeah.
And it's been, 4, if not 5 years since this whole kind of meme stock thing kicked off. And ever since then, basically, they are still a games retailer, but they've basically forgotten about that and are just jumping on the bandwagon of whatever the latest trend is. And maybe it is juicing the share price a little bit, but it's creating a hell of a lot of volatility. And it's not your core business, for God's sake. Just focus on selling games, do it well, and the results will come from that, not this gimmicky nonsense. And I realise I sound like an old man now, but
Mate, I'm a gamer and I agree with you. Stick to what you're good at.
Yeah.
Stick to what you're good at. I mean, basically the shares initially went up above $36 and then they dropped 9%. So, what good has it done? You're not MicroStrategy. You're a gaming company.
Yeah, absolutely. And just, I don't want to spend too much time on it, but the mechanics of it. If you're sat there and you want to buy Bitcoin, go and buy Bitcoin. You're not going to buy stock in a company that holds the Bitcoin and pay a premium for doing it. I really struggle with the investment case for that. Forget it. Go and sell games. Do that well. That's the end of the matter, really, I think, with them.
They've retreated to the core market in the US. They've dropped out of their loss-making operations in Italy and Germany. They bought $512 million. Now, if I was a shareholder, I would speak to the CEO and say, why are you spending this money on Bitcoin? Yeah. Where's the accountability here? What's your plan? You're a games retailer. You're making a profit now. Stop messing about with peripheral stuff that doesn't matter to your core business.
Yeah. Anyway. It's a little bit, just lastly on that, it's a little bit like when you see a firm go on a massive buyback program. You almost sit there and go, you've got all this capital. Is there really nothing better that you could do with it than buy back your own stock or buy a cryptocurrency? Yeah, put it back in the business. Get a return on it. Anyway.
Okay, finally, Broadcom. Obviously, given what we saw from Nvidia, again, another chip provider, just riding the big AI boom, done really well. And unlike Nvidia, it does have a VMware business, which is also doing well. So high expectations for Broadcom next week, also on the 5th. $4.1 billion in AI revenue, which was an increase of 77% out of a total of 14.92 billion in Q1. So Q2, 14.9 billion is what they expect in revenue for Q2.
Yep, and as you say, I think there are high expectations, and probably nudge those a bit higher, given how solid those Nvidia earnings are. The market isn't going to take any prisoners if Broadcom disappoint, given the quarter that their competitors just had.
So that's it for this week. Once again, thank you very much for your thoughts, Michael, and
Pleasure.
we'll be back same time, same place next week.
Indeed. Bye for now.
Cheers.